Hi everyone. In this lesson today, we are going to discuss about adjusted present value. Just to recall what we have done already, we started with NPV calculations and then we discussed about IRR, NPV differences, MIRR, all that we discussed. In the last class, we discussed about how to evaluate foreign projects, foreign investments, how do you find NPV. That's what we did in the last class. So today's area is going to be about adjusted present value. Adjusted present value. This is another version, or I can say another improved version of NPV. At the end of today's lesson, I will tell you when to apply NPV, when to apply APV, when in what kind of questions APV would be more applicable. I'll explain towards the end. First of all, understand how we find the APV, steps in calculating APV. Steps in calculation, right? Step number one. What step number one says is, evaluate the project's cash flows, or let me say this way, not evaluate, let's say calculate the NPV of the project, assuming it is 100% equity funded. What do? You take all the project's cash flows and you're going to assume it's a 100% equity funded company which is doing this project, which means you have to take KE ungeared. No need to take weighted average cost of capital because you're assuming it's 100% equity funded company, right? So here I would say in bracket, use KE ungeared. Ungeared companies KE should be used. Step two, calculate the present value of financing side effects. Financing side effects means, guys, now in the first step you have assumed the project is 100% equity funded, right? But so there what you're assuming is company uses internally generated funds, company uses its own reserves, company uses its own retained earnings. With that assumption you are using this first one, you're doing the first step. But actually what is happening is company is not using its own money, company might be raising funds. Company might be raising funds. It can be debt or equity. Company might be raising extra fund, not using its own fund. So when the company is raising some different fund, there are going to be some financing activities. With the question, I will explain you what this financing activity means. So because of those financing activities, whatever the additional cash flows you are getting, you analyze in the step 2. Calculate the present value of financing side effects using KD or risk-free rate. Technically, guys, KD and RF must be same because our assumption is debt is risk-free, right? Beta D, we assume it to be 0. So technically, KD and RF should be equal, but practically they are not equal. So either you can use KD or RF to get this present value. In the exam, you will be given marks for both. Step 3 will be adjusted present value equals the answers of, at these answers, step 1 and step 2 answers you have to add. Step 1 answer we call it base case NPV. Step 2 you say PV of financing side effects. I repeat, first one, calculate the NPV of the project assuming it's 100% equity funded. This is what you call base case NPV. Base case NPV. Clear? Now this steps might be a little confusing. When I do the question, I will tell you like what these steps mean. I'll show you a past paper question. Look at this past paper question. This has come very recently, 2 years back. Amberley Company is a listed company with divisions which manufacture cars, or motorbikes, and cycles. Over the last few years, Amberley has used a mixture of equity and debt finance for its investments. However, it is about to make a new investment of 150 million in facilities to produce electric cars, which it proposes to finance solely by debt finance. See, they are going to solely finance by debt finance. Okay, we'll see how it works. Project information. Humberley Company's finance director has prepared estimates of the post-tax cash flows for the project using 4-year time horizon together with the realizable value at the end of 4 years. Operating cash flows, so that doesn't include working capital. Operating cash flows means revenue, variable cost, fixed cost, taxes, all that. Realizable value is also given separately. Working capital of $6 million, not included in the estimates above and funded from retained earnings, will also be required immediately for the project, rising by the predicted rate of inflation for each year. Any remaining working capital will be released in full at the end of the project. Predicted rates of inflation 8, 6, 5 and 4. The finance director has proposed the following finance package for the new investment. Bank loan repayable in equal annual installments over the project's life, interest rate 8%, 70 million. Subsidized loan from a government loan scheme over the project's life, on which interest is payable at 3.1%. Issue cost of 3% of gross proceeds will be payable on the subsidized loan. No issue cost will be payable on the bank loan. Issue costs are not allowable for tax. Not allowable for tax. Financial information. Tax 30%, it's paid in the same year. Asset beta 1.14. Current return on the market is 11%, risk-free rate 4%. Chairman has noted that all of the company's debt, including new debt, will be repayable within 3 to 5 years. He is wondering whether Amberley Co. needs to develop a longer-term financing policy in broad terms. Calculate the adjusted present value for the project and conclude whether the project should be accepted or not. So this question is nice because very explicitly they have said calculate APB. Right. So let me proceed with my steps. What are the steps I told you? Step 1 is base case NPV. How do you find base case NPV? Calculate the NPV of the project assuming it's 100% equity funded. Right, we'll see. Here 0, 1, 2, 3, 4. They have given you post-tax operating cash flow, right? Let me say operating cash flow, OPCF. Operating cash flow is given post-tax. How much was that? In millions, they have given 28.5, 36.7, 28.5, 36.7, sorry, 44.4, 50.9, 44.4, 50.9. Investment, how much? Initial investment, how much was that? 150 million. So that and residual value 45. 150 investment, residual value 45. Yes. Then we have working capital, guys. Let me take that also, working capital. Then I can take net cash flow. Then I have to take discounting factor, which has to be KE ungeared. KE ungeared. I don't know how much. I have to find that also. We'll find that. PV base case NPV. So simple, like you take all the project's cash flows, guys, and then discount it at KE ungeared. That's where the difference is. Otherwise, it's just a usual NPV calculation. It looks like. Only difference is usually if it is NPV calculation, we will be taking WACC here, weighted average cost of capital here. If it is APV, if it is base case NPV that you are calculating, you take KE ungeared here. Right, working capital, let me do in one working. Working one. Working capital. Right? Here, 0, 1, 2, 3, 4. You write the working capital balance and then working capital cash flow. Right. Working capital balance, how they have given is immediately 6 million is required, which will rise with the level of inflation. Inflation is 865. Initially 6 million. Initially 6 million. Then it increases with inflation. So 6 into 1.08. Then 6 percentage, 5 percentage. So this figure into 6 percentage. This into 5 percentage higher. End of project it must be 0. End of project it must be 0 because you realize all your working capital towards the end of the project. That's a common assumption, right? Okay, so working capital cash flow will be initially whatever the investment has to be an outflow. Then you look at the increments. Whatever the increment, 6 has become 6.48. So that 0.48 is cash flow, outflow. You are investing. Similarly, you fill. We have done this several times. Let me link these things here. So net cash flow will be like this. Discounting factor, working number 2. Ungeared K. How do you get that? They have given you the beta asset. It was very easy. So you simply have to apply the capital asset pricing model. Capital asset pricing model. KE ungeared equals risk-free rate plus beta, let me say beta itself, beta asset. Do you know why beta asset? If you want to get ungeared KE, it must be beta asset multiplied by RM minus RF. If you use beta equity here, you will get geared companies KE. You know that, right? Asset beta, ungeared KE. Equity beta, geared KE. So since I need ungeared KE, let me use the asset beta. So you get the answer for KE. Risk-free rate was given. 4%, market premium 11%, 1.14. 4%, beta 1.14, as a market return 11%, risk-free rate 4%. So you get 11.98%, guys, which you can approximately say 12%. Yeah, it's approximately 12%. So ungeared KE, because it's very close, 11.98. Even if you take it to one decimal, it becomes 12. Yeah. So ungeared KE is 12%. Very simple. So here you take 1 divided by equal sign 1 divided by 1.12 raised to the power of year. So always year 0, whatever the discounting factor, it has to be 1, and then you get some numbers. Multiply to get the present value. Multiply cash flow and the discounting factor to get the present value. Base case NPV is the sum of all these present values. So isn't it exactly something like NPV calculation? Is everything same? You as usual you find the cash flow. Only difference is this guy. This fellow is the difference. Usually we use weighted average cost of capital. Here we are using KE ungeared. Cool. So base case NPV is 5.15 negative. That is what is step 1, finding the base case NPV. Now we will move on to step 2. Step 2. What is step 2? Financing side effects. Step 1 is what? Base case NPV. Clear? Now this thing you have to concentrate carefully. This might be new for you. Since the company is not using its own fund, since the company is not using its internal fund, since it is using newly raised fund, since it is using external fund, it usually gets certain other cash flows, guys. What are the other cash flows it gets? Remember, you will get usually issue cost is one thing. When you're raising finance, you may have to pay like the commissions or brokerage issue cost. Second one, tax shield is there. What is tax shield? If you are raising debt finance, on debt you are going to pay interest. On interest you get tax saving. Since you are raising loan, you get some tax saving, guys. That's what you call tax shield. Present value of tax shield must be taken. Another one, usually we get in an APB question, another one is subsidized loan benefit. Subsidized loan benefit, I will explain with this question. So let's take one by one, guys. Let's take issue cost. How much is the issue cost? Look at this carefully. Read the question. How much are they raising as finance? It's about to make a new investment of 150 million, right? Then they say bank loan repayable in equal annual installments over the project's life 70 million. So you are borrowing from the bank 70 million. Subsidized loan from a government loan scheme over the project's life on which interest is payable 3.1%, which is 80 million. So 150, this is how you are getting it, guys. 70 million you are getting from bank, 80 million you are getting from government. Issue cost of 3% of gross proceeds will be payable on subsidized loan. On this 80 million, you will have 3% issue cost. So how much is going to be the issue cost for you? Issue cost will be now look at this, guys. How you look at issue cost is, see what you borrow from the bank has to be something more than 80 million. Then only after you pay the issue cost, the balance 80 million you are getting into your hand. So what I'm going to say now, if you borrow 100 from the bank or from the government, 3 will go on issue cost, the brokerage fees. 97% is what you are getting to your hand. And that 97% has to be this 80 million. Do you agree? You borrow 100%, guys. 3% goes on issue cost, brokerage fees. Balance 97% only comes to you. And that 97% has to be 80 million. Then only you can make 150. So the full borrowing has to be, look at this carefully. See how I get the issue cost is 80 million is 97%. Therefore, how much will be 3%? Look at this carefully. 80 million is 97 percentage. Therefore, how much will be 3 percentage? 2.47. So actually what this means is, guys, total borrowing from the government should be 82.7 million. Agree? Why? 82.7 million you borrow from the government. 82.47, sorry, 47. Then 2.47 goes as your issue cost. Balance 80 million you can take for your project. Clear? So how much is the issue cost? 2.47. So let me say PV of issue cost. Very simple. Minus 2.47. Because when do you pay this? When do you pay this? At the beginning itself. When you are starting the project, you have to pay this. So there is no time delay. You don't have to discount it. But only thing, put the minus sign because it's an expense for you. So it's an outlay. Issue cost cleared. Now we'll see tax shield. Before tax shield, I'll do subsidized loan benefit also. Subsidized loan benefit means, guys, concentrate. Usually this company borrows at 8%, whereas this subsidized loan is given to this company at 3.1%. So you are getting at a lower rate, right? That's why you call it subsidized loan. How much lower interest you are paying? 8, 3.1. The difference of 4.9%, you are paying less. So I'm going to say, look at this. For your understanding, I will do step by step. Annual saving of interest will be, government borrowing you are getting 82.47 million. This is the total amount of loan, right? 82.47 million. Usually you pay 8%, but now you are actually paying only 3.1%. This difference I am going to give a name, annual saving of interest. Your interest cost goes down. Isn't it saving? It is. Clear? So if your interest amount goes down by this amount, right, then annual tax saving will be this figure into tax rate. How much is tax rate? 30%. Because this is the saving, right? This is the saving in interest, isn't it? Guys, let me redo this part again. Which one? Subsidized loan benefit. Let me redo this. Come again. Annual interest saving. You are talking about this government loan only. Government loan is 82.47 million. That's a gross amount of loan. You pay interest on the gross amount multiplied by. Usually you pay 8% interest. Now you are paying how much? 3.1% interest. So this difference is the interest saving to you every year. So this answer gives you interest saving. But understand, this is pre-tax, guys, because whenever you are saving some interest, your profit goes up, your tax goes up, right? So this I would say annual interest saving pre-tax, before considering the tax implications. Annual interest saving post-tax will be, guys, this figure multiplied by 1 minus tax rate. 30% is the tax rate, 1 minus tax rate. Because if you save $100 on your interest, then you will end up paying $30 tax extra, because profit goes up by $100. If profit goes up, your tax also goes up. 30 percentage. Clear? So to get post tax, you get this. And remember, this is an annual thing. Annual thing. It happens every year. For how many years? 4 years. The project is going for 4 years. So PV of benefit. PV of this particular benefit will be this 2.83 multiplied by annuity factor or cumulative present value factor, annuity factor at KD or RF. You can take either of it for 4 years. KD or RF for 4 years. $2.83 that's annual cash flow, that multiplied by annuity factor. Not your WACC, not your KE, it has to be KD. That's what the definition says. Right. So KD, how much? We'll use KD. How much is KD? Usual KD is 8%, right? 8%. Somebody can use RF also. RF also. Okay, let me use RF then. If you think RF is more applicable, whichever you can use, guys, you get marks in the exam. RF was 4%. Risk-free rate was 4%. So 4%, 4 years, I need to get the annuity factor. How much is that? 4%, 4 years. Let me use the formula. You can read from the table actually. 1 minus 1.04 raised to the power 0.04 raised to the power minus 4 divided by 0.04. I missed something. What did I miss? Power. The power sign has been missed, guys. It has to be a power sign here. Power sign. So you get 3.6299. So here I can say that will be 2.83 multiplied by 3.6299, this figure. $10.27 you are getting. But rather than writing step by step like this, let's now again write this same thing in one single step. Shall we try that? Are you ready? Let me rewrite this in one single step. How? Look at this carefully. PV of subsidized loan benefit. PV of subsidized loan benefit. Straight away I'm writing carefully. Look at this. 82.47 is the loan amount. 8% is the normal borrowing rate. But this loan comes to us at 3.1%. This is pre-tax. Let's make it post-tax. 1 minus 30% post-tax. So this is your annual saving multiplied by annuity factor, that is here. How is that? One step you're getting 10.27. Yes. So this is what I would prefer to be used in the exam. One step calculation. I like this. Don't waste your time doing it step by step like this. Don't waste it. So that's subsidized loan benefit. Done. Then we are coming to tax shield. Tax shield means what, guys? Since you are paying extra tax, you are going to get what? Tax saving. Since you are paying extra interest, since you are paying interest, your profit goes down, so your tax also goes down. So that tax saving is what you call tax shield. Tax shield on government loan. Let's take one by one. Tax shield on government loan will come. Listen to me carefully. Government loan is 82.47. Interest rate is 3.1%. So this is the annual amount of interest you are paying. So if this is the amount of interest you are paying, how much tax you are going to save? This into 30%. Guys, if you pay $100 interest, Your profit goes down by $100. So your tax goes down by $30, 30%. So interest into 30% tax percentage. This is the annual tax saving. Annual tax saving. I repeat, this is the amount of interest you are paying. Then you multiply by the tax percentage. So you get annual tax saving. Then you multiply by annuity factor, because this is every year, annuity factor, annuity factor. So you get 2.78. Right? That's a benefit for you. Tax saving, isn't it? Tax saving benefit. Tax shield on bank loan. In this question, this is a complicated thing. Tax shield on bank loan is a problem. Do you know why? Bank loan doesn't remain constant for all 4 years. Question says you are paying the bank loan in equal installments. So what you have as loan on the first year, what you have as loan in the second year are different. Understand? What you have as loan in the third year is again different. So the interest is going to be different, right? You are not paying the same interest. So let's find that. Look at this carefully. Look at this carefully. Loan amount 70 million. Interest rate. What was the bank loan interest rate? 8%. Term. This is a kind of a theory I am giving you. Learn this first time. 4 years. 4 years. And if they say it is paid in equal annual installments, did they say that? Go back and see. Did they say that? Yes. Repayable in equal annual installments over the project's life. Project's life means 4 years. So 4 years you are going to pay this equal. So how much will be the annual installment? Annual installment will be, guys, I'll give you the formula. Loan amount divided by annuity factor. This is a global formula you can use in any case whenever they say loan is repaid in equal installments. So let me have the annuity factor calculator somewhere here. 8%, 4 years. 1 minus 1.08 power minus 4 divided by 0.08. So that's the annuity factor, 8%, 4 years. So loan amount 70, annuity factor is this. When you divide it, you get 21.13 as the annual installment. Let's do a working now. Look at this carefully. Here, if you have done the reporting papers, you might remember a working like this. Look at this. 1, 2, 3, 4. Opening balance of loan, right? Then you add interest, then the payment, then the closing balance. Opening balance is anyway 70. Interest will be, guys, this 70 into 8%. Correct? 70 into 8%. Payment is always 21.13. Closing balance has to be 70 was already there, plus interest gets added, minus payment. That will be the opening balance. 54.47 is going to be the opening balance. Interest will be same. What? This into 8%. Payment is anyway same. 21.13. Closing balance will be same as that. What is that? Opening balance plus interest minus payment. Do that for every year. Can you see when you finish the table last year it must come to 0. If you have done the calculations correctly, last year it will come down to 0. This is what you call loan schedule, guys. Loan schedule. When with the fixed installment payment, this is how you do the loan schedule. What matters to me in this question is interest. This is what matters to me, because I am talking about interest and the tax shield from the interest. So let me take the interest separately now. Year 1, 2, 3, 4. Interest copy that interest. So tax shield will be the interest into 30%, right? If you pay 100 interest, tax benefit is 30% only. 30%. So that's the annual tax benefit for you because of this interest. That's your annual tax benefit. Multiply that by present value, guys, because I need to get that total present value, right? To present value, what you have to do, multiply by discounting factor. Multiply by discounting factor. What is the discounting factor we are using? Financing side effect, we have been discounting at RF, right? See, we decided the annuity factor at KDO RF, and we decided we will use RF. If we used RF here, for here also you must use RF. RF is how much? 4%. So 4%, 1 divided by 1.04 power year. Present value will be tax shield multiplied by discounting factor. Total present value will be right. Let me summarize now. Now we have done a lot of things, guys. Let me summarize. Financing side effect. Let me summarize. Financing side effect. Let me summarize. First we had issue cost. PV of issue cost. How much was the PV of issue cost? So how much was the PV of issue cost? Issue cost. We found it here. See, minus 2.4. So issue cost is a brokerage fee, guys. It has to be a minus thing. Yes, it is minus 2.47. I could have linked to that cell. Anyway, I'll just type the numbers. Then we had PV of subsidized loan benefit. PV of subsidized loan benefit. How much was that? That also we found it here. See, I told you can do step by step, but it's better to find it in one step altogether. 10.27 positive. 10.27 positive. Huge benefit, guys. Usually you are paying 8% interest, but this loan comes at 3.1% for you. Huge benefit. That's why that's 10 million something. Then PV of tax shield. We had two tax shields, one on government loan, other one on bank loan. Bank loan is this 4.03. Government loan how much? See, look at this carefully. Where is government loan? Yeah, tax shield on government loan 2.78. Why was this one line calculation? Government loan tax shield was one line calculation. Bank loan tax shield was so complicated. Do you understand why? Guys, here the loan principal amount did not change during the 4 years. 80 million or 82 million remained 82 million forever. So the interest you are paying every year had been same. So I just have to find 1 year's interest and then apply the annuity factor. But we can't do that here. Why? You are paying the loan in equal installments. Year on year you are paying part of the loan. Then your loan amount will go down. So your interest payment will go down. So year by year, I will have to find the interest separately. Year by year, I will have to find the interest separately. Clear? So this whenever this equal installment comes, guys, it gets complicated like this. Not really complication, you get some additional work. So this was how much bank loan tax shield? 2.78. That is also positive. Only the issue cost is negative. So get the total. So now let's say adjusted present value has to be base case NPV plus this financing side effect. Base case NPV how much? Minus 5.15 here, minus 5.15 plus financing side effect total 14.61. Adjusted present value 9.46. Clear? Since adjusted present value is positive, the project is financially worthy. Financially worthy. So again, look at this carefully, guys. What we did, first we take the project's cash flows as usual, use ungeared KE and find the present values. So you get base case NPV. That's very straightforward, nothing complicated. Complication comes in the other one. Then you go to financing side effects. Financing side effects, usually you get these three. Issue cost, tax shield, subsidized loan benefit. Issue cost is simple like this. Subsidized loan benefit is also somewhat easy. Tax shield is usually easy, but this question complicated because there was bank loan being paid in equal installments. So that made some additional working. So find the tax shield and everything. Financing side effect is this much. Add base case NPV and financing side effect. You get adjusted present value. Adjusted present value is positive, therefore project is financially worthy or acceptable. Clear? Right. Before we wind up the discussion about adjusted present value, let me give you a couple of other points. When is APV mostly useful? I'll tell you the situations where APV is mostly useful than NPV. If the project is funded by significant amount of loan such that the company's capital structure is vastly different from funding of the project. Guys, if you look at this question, they said 100% of funding to the project comes from loan. Whereas if you look at the company can't be 100% loan funded, no. So company's capital structure and the particular project's funding structure are vastly different. Company's debt to equity and the debt to equity of funding this project are not the same. Then you can't use NPV, you have to go for APV. Second situation, when the investment is in a different field than the company's usual stream of businesses or field of businesses, because guys, the risk is different. So you can't use company's risk, company's cost of capital to the project, because company's cost of capital will reflect company's businesses, whereas the new project is in a different business, so industry risk is going to be different, isn't it? So in that situations also, You can't use the normal APV calculation. So these are the two situations that APV would be more useful than NPV. Couple of times they have asked you directly when and when APV is more useful. Here you go, I give you another clue. How to identify that the exam question is on APV. Usually APV questions will have issue cost, subsidized loan, issue cost and subsidized loan. Guys, now we have done many investment appraisal questions. We never had issue cost, right? We never had subsidized loan, right? So this issue cost and subsidized loan are special features of usually APV questions. So the moment you see issue cost, the moment you see subsidized loan, you must carefully read the question. Oh yeah, it looks like APV. Understand? This is an exam technique I'm telling you. When you read the question, if there is issue cost and subsidized loan, that is mostly APV question. So there was one question, they gave data like this and they didn't tell you straightforward to use APV. They said evaluate the project. There you had to make the decision, since these things are there, since these conditions exist, we must better use APV. That decision you had to make. So watch out for this. Here guys, this is a theory question they can ask. This is something I'm just giving you a clue for you in the exam. Clear? So that's all about adjusted present value. Clear? What you must do, go through this video, you again try this question yourself and check the answers. Alright guys, good. So that's all on APV. In the next session or next lesson, we will see some more aspects of investment appraisal. We have only a little more to finish in investment appraisal. So maybe with another session or another lesson, we'll be done with investment appraisal. Thank you.